All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Tuesday, everybody. Today is July 21st, 2026. And our top story this morning, well, it's the AI bubble. We have got a lot of AI bubble stories going on this morning. First and foremost is in China, where the national team is now buying AI stocks. You might be saying to yourself, Jack, WTF is the national team? Well, that is the market's nickname for the Chinese sovereign wealth fund, state pension plans, government-controlled asset managers, i.e. all of the technically private businesses that answer directly to the Chinese government, which is like pretty much everybody in China. Yeah, they were piling into an ETF yesterday, a very chip-heavy ETF that has been volatile as all get out over the last couple of weeks. So we have got basically the Chinese government is now blowing into the AI bubble, propping up AI stocks. Well, isn't that fun? Keep in mind, you got Sam Altman has had his hand out to Uncle Sam or Uncle Donald for the last couple of months. This is the next logical step, and we have some stories in Japan that are similar to that. China has been every bit as volatile, or maybe not quite as volatile as things in South Korea have been. I mean, I know 100-year-old sticks of dynamite that are less volatile than the Kospi index has been over the last couple of days. But still, China, along with Japan, has been very volatile, and the NASDAQ for that matter. And so the Chinese government is blowing into the bubble. And of course, other market participants see the Chinese government blowing into the bubble, and they view that as the all clear. So they start piling in. And at the end of the day, oh, that's right, you still have a whole bunch of businesses that don't make money. But again, I'm pretty sure I'm the only one in the world who cares about that anymore. But hey, there it is. Now, as all this is going on in China, here domestically, we've got the hyperscalers, the hidden debt of the hyperscalers, the off-balance sheet financing arrangements, the secret debt has now reached $1.65 trillion with a T. I feel like I have to do Dr. Evil when I say that. $1.65 trillion of secret, hidden, off-balance sheet debt. That is according to Nikkei. And that is just for the 5 hyperscalers, which is Microsoft, Meta, Amazon, Google, and Oracle. And this hidden debt is on top of the projected $570 billion of bond issuance that those same 5 companies are expected to issue through the duration of this year, and on top of exhausting the more than $250 billion in free cash flow that these companies once generated that has now been completely consumed by the AI build-out. The numbers are getting so big now. Guys, this isn't funny anymore. What are we doing to ourselves? $1.65 trillion. Now, as all this is going on, the cost to insure Oracle's debt is now the highest it has ever been in data going all the way back to 2008, probably because Oracle not going to make it. And remember, last week, Oracle was downgraded. They had their debt rating, or their credit rating was downgraded to just one notch above junk. So still technically investment grade, and that threshold is very important. We'll talk about that, why that is later on. And don't think any of this, the exploding debt, the increase in the cost to insure that debt, and, China blowing into the bubble. Don't think for a second that is slowing down Nvidia and this circular finance wagon here. Nvidia this morning disclosing a 9.3% stake in NeoCloud Nebius. Well, that goes nice with their 11% stake in CoreWeave and their $2 billion of warrants that they bought for Iron, the other NeoCloud, and the deals they have to backstop the compute from Firmus and Sharon and CoreWeave and Lambda. And, well, yeah, NVIDIA is just buying their own product because, remember, they bought these shares of Nebius, this 9.3% stake. Millions of shares of Nebius were purchased in a private placement, not in the open market, which means NVIDIA gave that money directly to Nebius. And I'm going to give you one wild guess. What did Nebius do with that money? Oh, you don't think they bought NVIDIA's product, did they? No. So NVIDIA's just buying their own chips. Well, gee, if only somebody's been warning about that for the last several years. As all of this is going on, Japan is now relaxing bank regulations in order to allow even more money to be pumped into a number of industries, chief among them data centers. Sonai Takaichi is fully embracing the Keynesian economics this morning. And you know what? We've got like the Bank of International Settlements is warning about threats to financial stability from circular financing and hidden debts and lack of a return on investment. Sure, this sounds like a great time to relax your banking regulations to pump even more money into that bubble. What a great idea, Madam Prime Minister. Okay, off of the AI stories now, we've got a couple of other ones going on this morning. President Trump is threatening 50% tariffs on some Canadian goods. Looks like tariffs are back on the menu this morning. So what's going on? He's using this obscure law from the Great Depression era to threaten 50% tariffs on some of these goods. We'll talk about which ones. The tariffs that President Trump implemented after the Supreme Court struck down the tariffs he implemented last year, those had a calendar expiration date attached to them. That expiration date is coming up. So we're going to see a lot of headlines about tariffs over the next couple of months as the existing ones expire and get replaced with other statutes. Again, this is basically more fallout from the Supreme Court decision. We got 3M earnings, big beat and raise from 3M this morning. You better believe data centers is playing a role in that one. That stock is up. The Panama Canal is reducing bookings for ship transiting the canal due to a lack of water. Water levels in some of the lakes that make up the middle of the canal are dropping. And so basically every time a ship transits the canal, the locks raise and lower water levels. You consume a lot of water. And so they are letting fewer ships per day pass. Well, problems at the Panama Canal, that will go lovely with our many blocked straits, namely the Strait of Hormuz. We'll throw in the Sea of Azov and the Black Sea. And hey, and the Houthis were out there squawking on Channel 16 yesterday, threatening anybody in the Bab el-Mandeb Strait that the Saudis weren't allowed to use it. So I figure it's only a matter of time before they start shooting at somebody. Navigation is becoming an issue. And last but not least, we've got a warning from the power grid operator in 13 states about the possibility of rolling blackouts due to a heat wave this morning. That also goes nice with all these data centers that we're building in those same regions, big giant power loads when already the grid is having struggle keeping up with the weather. Yeah, that's all going to end really well. Guys, we got a lot to talk about this morning. Why don't we shrink my big melon of a head? Let's see what's going on in the world of finance. Don't forget that like button and that subscribe button so you can come have your coffee with the melon heads tomorrow because we do this every business day. Right now, the S&P 500 is higher by 32 points, about 0.4% in the green this morning. The Dow is up by 152 points or 0.28% to the upside. The NASDAQ is leading the way higher, up 366 points, 1.25% higher for the NASDAQ. We have tech is generally doing pretty well this morning, I suspect, on the heels of that news of the national team in China. Even the Kospi index, we're looking at daily candles now. That was up 3.5% yesterday, 230 points higher. Even though 3.5% for the index seems like a big move, that's actually the smallest move it's made in several weeks because, well, again, the Kospi has been volatile as all get out lately. But tech stocks pretty much across the world moving higher this morning, but it has been a wild ride this last month or so. Looking over at the DXY, we've got the dollar is 6 basis points higher this morning after making a nice run yesterday, 101.02 for the DXY. Looking over at the bond market, we've got small moves in yields this morning. The 30-year yield is higher by 0.5 point at 5.123%. The 10-year yield also up a little more than 0.5 point, 4.604% for the 10-year, back above that 4.6% level for the 10-year Treasury bond. The 2-year, meanwhile, 4.221. That's also up by about 0.5 point. And the 1 month is up not even 0.5 point, fraction of a point here, 3.698% for the 1 month. So bonds are going a whole bunch of nowhere this morning. Bitcoin is higher by about $1,350 this morning, 2% higher at 66,561 for Bitcoin. That is the highest we have seen since the middle of last month. Bitcoin enjoying the rally in tech today. Again, I don't think Bitcoin winner is quite done with us yet. Looking over at the commodities board, we've got metals are looking good this morning. Spot gold is higher by 1.25% or $50 in the green at $4,057 for spot gold. Spot silver, meanwhile, is at $58.82. That's higher by $2.41 or 4.25%. Good morning for silver, and I like the shiny. Copper's higher by 2.9%. Platinum's higher by 1.25%. Palladium is up just 0.1%. And WTI crude is also higher this morning, 84.38 for September WTI futures. That's higher by another $1.88 or 2.25% higher. Still, all things considered, $84. And, we potentially could have the Red Sea acting up again on top of the Strait of Hormuz. Oil remains very tame at these levels. All right, but let's talk about the big one this morning. China unleashes broad state support to halt tech stock sell-off. All right, who had the Chinese government buying tech stocks on their AI bubble bingo card? Sure, why not? It's like an offshoot or spinoff of the 2020s bingo. China is mounting one of its broadest efforts in years to steady the stock market, with regulators, state-backed investors, insurers, and asset managers all moving to shore up confidence after a sell-off in tech shares. The coordinated push shows Beijing's determination to stop the rout in AI and semiconductor stocks from turning into a broader market confidence crisis. Investors have grown wary of lofty chip valuations and a shift of funds toward the upcoming listing of memory maker CXMT. Over the longer term, keeping AI stocks buoyant could also be a way to help Chinese companies raise the capital they need to compete with the U.S. The latest sign of support came on Monday when the China AMC Star 50 ETF, that's the largest fund tracking the chip-heavy index, attracted a record 13.8 billion yuan or $2 billion of inflows. While the source of the buying wasn't immediately clear, traders say the scale of the inflows suggested state-backed capital was being directed toward technology shares, where the sell-off has been most intense. In other words, the inflows were so big, it could only be the government pushing people to buy this. The Star 50 index surged 11% on Tuesday, its biggest one-day gain in nearly 2 years. Last week, it tumbled around 17% as investors unwound leveraged positions at the fastest pace since the 2015-2016 market crash. You may recall the 2015 China stock market crash was particularly brutal. Investors in AI had been searching for any sign that policymakers were still willing to back the trade, said Zhuang Zhipeng, fund manager at Shenzhen JM Capital Corp. The national team's buying of the Star 50 ETF provided exactly that signal, prompting funds to wade back in after interpreting the move as an official vote of confidence. All right, so they're buying it not because AI is the next best thing, but they're buying it because the government is buying it, and the government has infinite money. So, okay, sure. It's almost like the Fed put. The national team is clearly intent on slowing the pace of losses and cushioning the decline in technology shares, where positioning had become especially crowded, said Wang Zhuo, a fund manager at Shanghai Zhuzhu Investment Management Company. I'm sure I mispronounced something in there. I apologize. Ultimately, the only real solution is for the market to return to more reasonable valuations. What? Market return to more reasonable valuations? Get this guy out of here. Doesn't he know what year it is? Come on. Reasonable valuations. What will they come up with next? Yep, Chinese government piling into stocks. Meanwhile, 5 U.S. tech giants' hidden debts soar to $1.65 trillion on opaque AI funding. Take a minute and appreciate that number, folks. We're no longer talking about billions, tens of billions, not even hundreds of billions. We are now into the trillies. $1.65 trillion of hidden debt on the 5 hyperscalers' balance sheets. What's the worst thing that could happen? It's $1.5 trillion of debt just lingering out there somewhere. Who holds it? Who owns it? Who do we owe it to? Trifle details. Who cares? Just keep pumping more money into your data centers. Data center leases, GPU supply contracts raise liabilities at Meta, Oracle. Nikkei study shows hidden debt at U.S. tech giants swelled 8-fold in 4 years to an estimated $1.65 trillion as AI investments ballooned, a Nikkei study showed, exceeding actual debt and making it tougher for investors to assess risk. Nikkei examined recent financial statements and other materials from Google owner Alphabet, Microsoft, Amazon, Meta, and Oracle. The 4 companies, aside from Oracle, are scheduled to announce their second quarter earnings from Wednesday, meaning the figures may increase even further. The 5 companies' hidden debt, which does not appear on balance sheets, totaled $1.65 trillion in the most recent quarter, exceeding the roughly $1.35 trillion in debt reflected in their balance sheets The data includes some estimates. All right, so this is important here. This does not appear on balance sheets. When these companies report their earnings and they report their assets and their liabilities, they're reporting $1.35 trillion of debt. There is an additional $1.65 trillion of debt that nobody can see. They're using these intermediaries and these special purpose vehicles in order to hide it. Hey, that's exactly what Enron did, but you don't let that bother you. Meta's off-balance sheet debt is particularly high at about $420 billion, nearly triple its actual recorded debt. These companies are rapidly bolstering their data centers and other computing resources to power AI development and are entering into long-term purchase agreements for graphics processing units and servers. Institutional investors are becoming increasingly involved. Meta formed a joint venture with funds managed by US investment firm Blue Owl Capital to build a massive data center in Louisiana, the total development cost for which was announced in 2025 as $27 billion. That cost has ballooned, and it's not like Blue Owl Capital has their own problems. I'm sure things are going great over there in the private credit space. By investing in the data center's operating company with a 20% stake and using the facility under a lease agreement, Meta secured computing resources, but also increased its hidden debt. That's the thing. They created a shell company, and they're putting all the GPUs in the shell company, and then Meta is just renting the GPUs. And then that shell company is borrowing money using Meta's lease obligations as collateral. Meta has a contract guaranteeing investors' losses if the data center becomes unnecessary and the lease is terminated. The company announced on July 3rd that its total investment in the facility is now expected to exceed $50 billion. Hey, they told us last year it was a $27 billion data center. This year it cost $50 billion. But remember, inflation's only 3 or 4%. Tech giants are already relying on issuing corporate bonds and new shares because their investment expenditures are exceeding their earnings. Their fundraising from institutional investors on top of that is leading to overheated capital investment. In a March report, economists at the Bank for International Settlements referred to the mechanism of raising funds from institutional investors without increasing debt on their balance sheets as shadow borrowing. They expressed concerns about the risk of data center projects stalling and AI anxieties spreading throughout the market. They actually called it a risk to financial stability. And financial stability is, that's regulator speak for everything going to hell in a handbasket. They don't use those words lightly. An executive at a Japanese auditing firm said concerns were growing that the tech company's actual financial burden is significantly larger than what can be seen on their balance sheets. U.S. energy company Enron, though fundamentally different from tech giants, collapsed in 2001 due to off-balance sheet debt hidden behind multiple shell companies. Even with proper accounting practices, an increase in joint ventures with low transparency could raise concerns in the market. Much of this hidden debt will eventually be recorded. When data centers start up, the related debt can suddenly become very real. And if AI demand does not grow as expected and utilization rates fall, the data center's asset values could decline, leading to losses. Today's AI industry is partly supported by demand generated by circular investment. Oh, if only somebody had been warning about that. Nvidia and tech giants invest in data center operators and AI companies, and with that money then turning into GPU and cloud usage fees, actual demand is difficult to see, increasing the likelihood of overinvestment in data centers. Let me just throw this out there, guys. Maybe the reason actual demand is difficult to see is because there isn't any. Maybe you can't see it because it's not there. Because maybe, just maybe, all of the demand for this crap, which is all operating at a loss, has been completely manufactured by the big tech companies and their Wall Street friends, the biggest investment bubble in human history, and it has all been a mirage. Maybe that's why it's difficult to see. Or maybe the trust me, bro, and the hype and the TED Talk stuff. Maybe that's the case. But as this is all going on, we've got Oracle credit risk hits near 18-year high on AI debt load angst. And the only reason it's an 18-year high is because we only have 18 years of data. It doesn't go back that far. The cost of protecting Oracle's debt against default reached a fresh multi-year high on Monday, while its existing bonds sold off as doubts grew over whether the company's massive investments in AI will pay off. By the way, this is the cost of protecting Oracle's debt that we can see. This is not the 1.65 trillion of off-balance sheet debt. This is the cost of insuring the other pile of debt, the 1.35 trillion that we can see that belongs to all the hyperscalers. 5-year credit default swaps on the company's debt, a gauge of perceived risk, rose to about 2.03 percentage points annually early on Monday, according to ICE Data Center Services. That marked the highest level on record for data going back to the end of 2008, surpassing the previous peak of 198.23 basis points reached on Friday. All right, so it's the highest ever, surpassing Friday, which was only one trading day ago. And you can see here, guys, this chart shows the cost of insuring Oracle's debt. It's going vertical, and it's still rising here. Oracle, the biggest issuer in Bloomberg's U.S. high-grade corporate bond index outside of the financial sector, has become the credit market's barometer for AI risk. S&P Global Ratings downgraded the company earlier this month to one notch above junk, citing the company's growing spending on AI. Investor focus should shift to any changes by Moody's Ratings, which has a Baa2 on the firm with a negative outlook, as Oracle continues its spending spree, according to Morgan Stanley credit analyst Lindsay Tyler. Fallen angel risk is not immediate, especially with equity and prepayment levers, but remains medium-term dependent on execution and monetization, Tyler wrote in a note dated July 9th. All right, that statement's kind of important there. Fallen angel risk is not immediate. First of all, what is fallen angel risk? Fallen angel is when a company's debt was previously considered investment grade and it gets downgraded into junk status. If it gets downgraded into junk status, there's a lot of institutions like pension funds that are not allowed to invest in junk debt, which means if your debt gets downgraded into junk category, all of a sudden, a lot of people with a lot of money are forced to start selling your debt, which could really spike your borrowing costs. That's known as a fallen angel, when you fall out of investment grade into junk and the forced dumping of your debt happens. So what this analyst is saying is, don't worry, there's no immediate risk of that happening because they were just downgraded to one level above junk last week, which means it might be a few months before they get downgraded to actual junk, even though the fact that their CDS is trading at over 2%, that's already in the realm of what junk debt trades at, or CDS on junk debt trades at. And look, Oracle's reporting their earnings in a couple of weeks here. They're showing no signs of changing their mind. They can't stop. If they stop, their shares tank even harder. And look at what their shares have done. Just look at this stock pattern. These are daily candles going all the way back to 2021. And don't you just love that head and those shoulders, huh? Oh, Oracle. By the way, the price target for that head and shoulders pattern is a goose egg. It's zero. Oracle, this company may not survive this bubble, guys. There's a very good chance they just don't make it. But right now, the stock is $122.95. It's up by 1.3% ahead of the opening bell. All right, round and round we go. Nvidia discloses 9.3% stake in neocloud computing firm Nebius. Another one. They bought shares in another of their own customers. Nvidia on Monday disclosed a 9.3% stake in neocloud computing firm Nebius after the AI major announced a $2 billion investment in the firm earlier this year. Nvidia disclosed a 9.3% stake in Nebius, comprising roughly 22.26 million shares, including shares from a warrant obtained as part of its $2 billion investment, a filing showed on Monday. Nvidia is currently prohibited from exercising its warrant prior to September 11th, the filing showed. Nebius shares rose 3% in aftermarket trade. Nvidia's investment in the company is one amongst its many holdings in the AI ecosystem and data center infrastructure. As the world's most valuable firm pushes for more AI adoption, Nebius is also a customer of Nvidia. The company, along with CoreWeave, is among the so-called neocloud firms, a group of fast-growing data center companies with high-profile deals to specifically power AI infrastructure. Now, this is also the same Nebius that recently transitioned to an asset-light data center model, which means I seriously doubt Nvidia is going to buy any more shares of this company, because Nebius is saying we're not going to buy any more GPUs. And the only reason Nvidia is buying these companies is to inflate their own sales. So who's going to get that future Nebius business? I don't know, maybe Iron, maybe Firmus, maybe Sharon, maybe Lambda, maybe CoreWeave, maybe any of these other neoclouds that NVIDIA hasn't invested in. But keep in mind, guys, as NVIDIA invests in all of these companies, like here's Nebius stock, it's up year to date quite a bit. And so NVIDIA can report earnings by increasing the value on their books. This is how you manufacture earnings because it's worth more than it was when they bought it. And Nebius currently $192.8 or $193 a share. It's up $10 on this news. But keep in mind, what happens if this bubble bursts and if CoreWeave stock tanks and Nebius stock tanks? Not only does NVIDIA's sales go in the toilet, but NVIDIA's assets start to get devalued also. And that's how all of these investments become negative earnings in the future. And I guess I should say, full disclosure, I am short NVIDIA. So with all of this risk and with the Bank of International Settlements warning about threats to financial stability, it seems perfectly logical that Japan would relax bank rules to fund Takaichi's growth ambitions, right? Let's make it less cumbersome for the banks to invest in the biggest asset bubble in history. Sure, that sounds like a great idea. Japan will relax rules on bank lending for M&A and encourage pension funds to invest more in alternative assets as part of Prime Minister Sanai Takaichi's economic growth initiatives. Banks will be allowed to lend beyond existing caps when they finance large-scale mergers and acquisitions, as well as projects such as AI data centers. The government will also make it easier for investment firms owned by banks to provide equity finance for buyouts and corporate carve-outs. Under the package, the government will also examine so-called firewall regulations that ban sharing of client information, even between commercial banks and securities units under the same financial groups. The steps are part of a package of wide-ranging measures announced Tuesday covering the financial industry's role in supporting Takaichi's economic plan. The government wants to spur private investment in 17 growth industries, including artificial intelligence, semiconductors, and shipbuilding. Takaichi has set a combined public and private sector investment in these areas totaling 370 trillion yen. That's about $2.3 trillion in the period through March of 2041. And relative to Japan's GDP, that is a staggeringly large number. They are spinning up the money printers in Japan here. And again, we got all these risks to financial stability, hidden debts, off-balance sheet arrangements, special purpose vehicles, round-trip financing schemes, the biggest accounting fraud in history. Yep, great time to relax bank rules to pump even more money into that bubble. That is going to work out just great. All right, we've got 3M stock is soaring this morning after a big beat and raised quarter. You better believe data center construction is showing up here. Growth is picking up, 3M earnings revealed, and the stock is acting accordingly with shares up more than 5% in pre-market action. The industrial conglomerate reported second quarter earnings per share of $2.40 from sales of $6.5 billion on Tuesday. Wall Street was looking for earnings of $2.25 from sales of $6.4 billion, so we got a beat on the top and the bottom line. A year ago, 3M reported earnings per share of $2.16 from sales of $6.2 billion, so we got nice year-over-year growth. Comparable sales grew 5.4% year over year, up from 1.2% growth in the first quarter. Let's see. For the full year, 3M now expects earnings per share of between $8.80 and $8.95 from sales of about $25.4 billion. That's up from prior guidance in April of adjusted EPS of $8.50 to $8.70 from sales of $25.3 billion. So it's a beat and a raise from 3M. Now, 3M, everybody's like, oh, it's the Post-it note maker. 3M makes everything. They make air filters, safety equipment, industrial solvents, abrasives. They also make electrical, optical connectors. So it's a good bet that the build out of data centers is reflected in 3M's earnings here, because I doubt people are just using more Post-its than they used to. Right now, the stock is ripping this morning, up 8.25%, $172.91, higher by $14 year to date. This one is now just about even, actually, year to date. But good morning for 3M. We've also got President Trump vows 50% tariff on Canadian goods using Depression-era law. All right, we're back to the tariff thing. The Trump administration vowed to impose a fresh 50% tariff on some Canadian goods over what it said was unfair treatment of American alcohol, cars, and dairy, further inflaming trade tensions between the two neighbors. The items subject to the new tariff include milk, hockey equipment, beer, and plywood, but not major resource imports such as energy, potash, and critical minerals. Goods covered by separate duties on industries, including autos and steel, will also be spared. Crucially, for the items on the new tariff list, there will be no exemptions for exporters shipping under the rules of the existing North American Trade Pact between the U.S., Canada, and Mexico. The Office of the U.S. Trade Rep estimated that $20 billion worth of imports, or about 5% of total Canadian goods sent to the U.S. last year, would get hit. The tariffs are being applied under Section 338 of the 1930 Tariff Act, which gives the president the power to impose duties of as much as 50% on countries deemed to discriminate against U.S. commerce. The provision has never before been used to impose tariffs, according to the U.S. official. Look, for all we know, he's going to taco on this next week. We've seen big high numbers thrown out, and then a few days later, we're negotiating in good faith, so we're going to punt for 90 days. Maybe that's it, or maybe this is just the expiration of the tariffs that were put in temporarily after the Supreme Court decision, and now they're just going to start replacing them piecemeal. Either way, it's about 5% of goods that we trade with the Canadians. Meanwhile, global trade faces a fresh test as the Panama Canal curbs bookings. It's not a huge reduction, but any threat to global trade with everything that's going on at sea right now in the other half of the world is worth paying attention to. Global trade faces a fresh headache on top of the months-long snarls in the Middle East that have roiled flows, with the Panama Canal moving to curtail some vessel booking slots because of water supply challenges. The Panama Canal Authority will temporarily suspend part of the booking system for ships seeking to use the waterway linking the Pacific and Atlantic Oceans. That's according to shipping agent Norton Lilly. Among the reasons is that a weather-altering El Nino may hit, curbing vital water flows, it said. Daily auctions in so-called Period 3 for the Panama Canal's Panamax class locks will be halted from July 25th until further notice, given present and projected water levels at Gatun Lake, Norton Lilly said in a notice on its website. As a result, daily booking capacity will be cut from 36 down to 34 vessels. The suspension is being introduced based on current hydrological conditions, as well as the potential development of an El Nino weather pattern, it said, citing the authority. Previous El Ninos have dried up freshwater lakes supplying the canal, causing the authority to impose daily transit restrictions. Guys, I suspect between now and next year, we are going to be hearing a lot about this El Nino. Supposedly, the strength they're estimating is going to be one for the record books. It's going to affect global agriculture, and it's going to affect global shipping now, with the Panama Canal dropping from 36 to 34 vessels. That may not seem like a lot, but you've already got a lot of oil right now being shipped out of the United States, for example. We're exporting more oil to try to help fill the gap in Asia that would normally have come from the Middle East. Well, that oil's going through the Panama Canal after it loads in Texas and Louisiana. Now it's going to be a little bit harder. And, Houthi and the Blowfish are threatening to act up in the Red Sea too. So global shipping is not getting any easier. And last but not least, guys, just a heads up for my friends in the central states of the U.S. Prepare yourselves for blackouts potentially. Grid operator in U.S. central states warns of potential rolling blackouts. This one just yesterday. The regional U.S. grid operator for 14 central states warned on Monday evening that it could order rolling blackouts because the power system was on the brink of an electricity shortfall due to record demand. Several power plants unexpectedly tripped offline, leaving reserve margins razor thin amid a heat wave in territory stretching from North Dakota to Louisiana. The pool, called the Southwest Power Pool, issued a level 3 energy alert, meaning the grid operator used some or all of its operating reserves to service demand. The grid operator said it had not had to order rolling blackouts yet, despite the high risk. And here is a map of the states in that Southwest Power Pool that are susceptible to those rolling blackouts. So should you find yourself in those red areas, guys, have a plan for if the power goes out. In particular, for older relatives, if they lose their AC, have a plan to take care of grandma or pop in such a situation, because it is wicked hot in the central states these days. And I just want to say thank you, everybody, for having your coffee with the Melonheads this morning. Don't forget the like button and the subscribe button for you new guys so we can see you all tomorrow. Thank you very much to my magnanimous melonheads on Patreon, YouTube members, and Buy Me a Coffee for supporting the channel. There are links down below should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.